This is another example of a stock that I have rejected yesterday. So as you can see, this is the current price of the stock. The market is currently on. So if I remove this candle, well, this is what I saw yesterday, and I said no to the stock. I rejected the stock. So let us try to understand what's happening here and why did I reject the stock. And as I have mentioned earlier, your trading performance largely depends not on what you buy, but on what you choose not to buy. Okay, it is very important. If you have four stocks on your watch list, you plan to buy them all. Okay, and three of them have odds which are not in your favor. Then you actually need to have only one stock in your watch list, not three. Okay, so that is why I have made this playlist where I discuss stocks which I have not selected for trading. I discuss stocks where I have not put my money. Okay. So let us look at the moving averages. The 50-day moving average is above the 150-day moving average, which is above the 200-day moving average. So this is a strong stage two uptrending stock. That's a good sign. Then you have more than 10 candles in the base. That's fine. Then if you draw the base, the high of this candle is 758.55. The high here is 758.80. So if I draw the base, this is 0.1, that's 0.2, that's 0.3, 0.4, 0.5. So there are 5 points in the base. So the yellow line is point number 3, which is 758.80. So 758.80. So this is how the setup looks like. Now, number one, the reason why I am uncomfortable with this base is you look at the volatility in the base. Look at this candle. It's an 18% candle. Then you look at this candle, very long upper shadows and lower shadow. Then suddenly you have a large candle. Then suddenly you have a 4% drop. Okay. Look at these long shadows. So, number one, volatility in the stock. Okay. Number two, volatility is a negative sign. Number two, after point two, the stock has gone up rapidly into the blue zone and the green zone. It is not spending time trying to consolidate. There is no price tightness on the right side of the base. So here it's like a V-shaped recovery. V-shaped recovery is dangerous. See, what I would like to see in a stock is this. From here, it goes here, then it goes here, comes down, goes here, comes down. If I see this kind of proper consolidation and price tightness on the right side of the base, only then I would be comfortable investing into the stock, because this stock then has taken proper rest and is now ready to start the next leg of the rally. But that's not happening here. This is too volatile, and suddenly the stock has dropped 4%. So I could choose to buy at the yellow line, but I don't want to do that because I want to see price tightness on the right side. I want to see price tightness. I also want to see volume contraction. Volume contraction is there here, but price contraction is not there. So this is about the base. Although I have 4 points in the base, which meets my criteria, and although I have the yellow line in the green zone, I would still not put my money because this recovery was just too fast. The stock has not had time to rest. See, if you are climbing a mountain and if you don't take rest, you will not reach your destination. You will have to first start climbing, then set up a base camp, take rest, regain back your energy, start again set up a base camp, regain back your energy, and then start again. That is how uh, properly you climb the mountain. But that is not happening in this stock. You have a sudden upthrust which is not likely to sustain. The probability that this stock will go up is low, and probability that even after the stock goes up, the probability that it will sustain there and it will continue to go up is very low. So I don't want to get into a low probability situation, even if it meets all of my criteria. I want a properly formed, consolidated, tight base towards the right side. Only then I would be interested in buying the stock. Okay, in such cases, even if I buy the stock like 1% above the yellow line, it is still okay because it is coming out very powerfully. The supply on the right side has probably dried down. Okay, here it's too volatile, which makes me uncomfortable. Apart from this, you look at the data on market smith. Okay, let us look at overall how the stock has been doing compared to the market. So this is the market smith data. Okay, so look at these ratings. The EPS rating is 77. What does that mean? It means that out of all the stocks in the Indian stock market, there are 23% of stocks which are doing better than this stock in terms of earnings stability and earnings growth. Now, 23% of 5,000 stocks is more than 1,000 stocks, correct? So, if 1,000 stocks are doing better than this stock in terms of earnings, why should I put my money in this stock, right? So, this rating weighs on my decision making, okay? I don't give too much importance to the fundamentals, but when the base itself is weak and the earnings rating is also weak, it's like there are too many negative factors which is pulling me away from the stock. I don't want to get involved in this situation. Number two, price trend 73. What does this mean? This means that out of all the stocks in the Indian stock market, 27% of the stocks have done better than this stock, which is Subros, on a 52-week performance basis. So there are more than 1,000 stocks in the Indian stock market which are doing better than this stock in terms of their 52-week performance. So why should I waste my time putting my money here? Okay. Accumulation distribution rating is B. I would prefer this to be A. Group rank is 38. I would prefer this to be less than 20. So not a lot of convincing data here. Management ownership is fine, but see the number of funds that are holding the stock has increased, but the absolute number itself is very small. In some companies, you have these number in the thousands or hundreds, but here is not even 100. Moreover, you look at the standalone, this is fine. The percentage change in quarterly earnings. This is the quarterly sales growth 160%. This number should be at least 40% as per Patrick Walker. If that is not 40%, then the average of these two numbers, which is quarterly sales growth, at least the average of those two numbers should be 40%. Okay. But in this case, earnings growth is fine, which is probably why it is showing 77, but not convincing enough. So looking at these numbers, which are not convincing enough for me, okay, the rating comes down probably because of stability factor, not because of the growth factor. The growth is there, okay, you have triple digit growth, but the growth is very volatile. Okay, sometimes you have 200% earnings, sometimes you have only 66% earnings, so it's not consistent. We need growth in earnings, we need stability in earnings, we need consistency in earnings for this rating to be very good. Okay, see, I am not saying this stock cannot go up. Okay, the stock could go up and continue to remain there. All I am saying is that given all the factors that we are discussing here, the probability that the stock will go up and continue to sustain there is very low. Okay, so I am only looking for high probability situations. Okay, if I want to buy a stock as a positional trader and hang in there for a long period of time, in those cases these factors become very important. But if I am a swing trader, I just want to capture 10-20% move, okay, and then sell the stock and sit with the profits, then I wouldn't look at all of these data. I am looking for stocks where I can hold on for a long period of time. That is the nature of my personality. Earlier, I used to do a lot of swing trading, but over a period of time, I realized that the more I slow down, the better it is. The more I give stock time to fluctuate around a certain level, the better it is. I don't see, we don't need to do much effort to make money in the stock market as long as the stock that you have selected continues to go up. Okay. We don't need to do much. We don't have to disturb the stock as long as we have taken the position at the right time, at the right place. Okay. So, considering that philosophy, I want to see stocks which show that kind of potential where you have good price strength, good earnings ranking, coming, the stock is coming from a strong group, good institutional accumulation, nice base forming on the right side. When all of these factors come together, that gives me the confidence to put my money and stay in the stock for a longer period of time. So now you understand how much time I am taking just to reject a stock. That is why I continue to say your trading performance is not about which stocks you buy. It will be largely determined by the stocks that you don't choose to buy, because if you avoid such stocks, you will significantly reduce your losses. And if you significantly reduce your losses, you will get to keep your realized and unrealized gains, right? And that will add up over time. Thank you so much.